So you're wanting to buy your first home. That is very exciting news. And the first question that comes along with it is, are you prepared? And I would say, that is why everyone is here today, so they can be better prepared when they are purchasing their first home. One of the best parts about all of our jobs and the experts that are up here today is that we help people and individuals purchase their first home. And then we know that the process can seem a little daunting at first, but our team of experts have an in-depth industry knowledge, and we're here to help you along the way. So I'd like to just take the time quickly to introduce ourselves. This is Natalie Keshavarznaya, realtor with Royal LePage and founder of the Kesh Group. And then we also have Rob Taylor here from CMHC, which is the Canadian Mortgage and Housing Corporation, one of the three main insurers in Canada for insured mortgages. Okay. So Natalie, I'll give the floor over to you.
Pass on the mic, and I'll try not to step on this cord. All right. Hi, everyone. I'm Natalie Keshavarznaya. I own the Kesh Group, Royal LePage real estate team. Thank you so much for coming tonight. So tonight, Natalie Turner and Rob are going to talk about why financing is important, not only for first-time homebuyers, but just buyers in general. So when we first meet with our clients, our first question as realtors is, what are you approved for? What's the amount that you can borrow? So we know exactly what type of house you're looking for, what neighborhood you're looking in, and all of those facts that help us along the way. It's really essential that you are pre-approved first. That is your first step before we even start shopping, which is the fun part. It's very essential because we need to know exactly what your lender, mortgage broker, or bank is saying. And then we move on. So during the night, if you have any questions, realtors in the back, Marissa, Kate, and Reed, and myself are here to help you with any questions you have, anytime after or during. Okay? So I'll pass it on to Natalie. Okay.
Okay, and as Natalie mentioned as well too, if there are any questions during the entire seminar, feel free to just interject, put up your hand, or shout them out. We'll be happy to answer them as the seminar goes along. If there's any terminology as well too that you'd like clarification on, please don't hesitate to ask. So one important question that I always get asked is, why would we use you as a mortgage agent? What is the benefit of using a mortgage agent or a mortgage broker as a whole when purchasing your first home? Primarily, I would like to say is that it's options. We're able to provide you with numerous options. I work with over 30 different lenders on a daily basis. I work on your behalf and not on the lender's behalf. As well too, I am your personal liaison between the lender and between yourself. Most of you probably have a financial institution or a primary financial institution that you deal with on a regular basis. So whether that is like Meridian, TD, Scotia, Penn Financial, First Ontario Credit Union, I have access to those lenders through the broker channel as well too. So if those are the lenders that you feel comfortable working with, when we are seeking out lending options for you, please let me know and I can see if your mortgage fits with that lender. Also as well too, my services are free. So, who doesn't like free things? I'm able to seek out the best lending options, the best terms, the best rates for you. In actuality, you can compare me to an insurance broker or, with car insurance or with home insurance. I'm able to do all of the work and the legwork on your behalf. When you're going into one financial institution, such as TD, let's say, they are only able to provide you with their lending options. You have to fit into basically their box. And if for some reason you don't meet their lending guidelines, you would have to go and try and seek out other options. With me, you're able to provide me with all of your information. I get to know you on a personal basis when it comes to credit history, employment, life stage, finances as a whole, and I'm able to advocate to those lenders on your behalf and to tell your story, which I feel is very essential. Another important factor of using a mortgage agent is that we normally only do one credit pull, or we only look at your credit bureau once. And I would typically say that is done when you are in the home buying process and when you're ready to as well to submit and offer. I can get to know your credit history a little bit more before that as well too. But when you're going to a financial institution on your own, they will usually pull your credit once there. And then if you don't fit their lending criteria, you will have to go to another lender and they would pull your credit bureau there as well too, which ultimately too many pulls will have a negative impact on your credit score. I focus on mortgages and I focus on mortgages alone. They are my bread and butter, so I'm not going to try and cross-sell you. I am basically there just to work on your behalf. Okay, so next we're just going to talk about, does anyone have any questions in regards to that?
One question, you said about mortgage and loans. We have to? If we have the money, why bother?
Well, if you have enough cash outright to be able to purchase a property, it does not have to be mortgaged then.
Well, I'm sure.
Yes, of course.
But the only thing you said about first-time home buyers, you're gonna do a credit check. I'm like, fine, I just told you, we have the money. We're ready for the credit. We want this place, we want this place. You're gonna crush and say, well, you haven't got credit. You never bought anything in your life, blah, blah, blah. Well, what do you expect? So where's our credit? So you're gonna turn around and say to me, well, you can't have this house, you're not good credit. Thanks for crushing my dreams.
No.
See you till next time. So you tell me, as a first-time home buyer, what are you gonna say to me now?
So-
This is the biggest fear. I don't want to hear bad credit.
Okay, so credit does play a very important role when you are trying to obtain a mortgage. The lender wants to see good repayment history, and if your mortgage is going to be insured as well too, the insurer wants to see good repayment history and financial stability. Your capability to repay on a regular basis and to be frugal and manage your money properly. But if, like you were saying, you have enough money to buy the house outright, then you wouldn't even need to go to a mortgage agent or a broker, and it wouldn't have to be insured through one of the insurers or through CMHC. So at that point, credit does not play a huge factor because you're going to be able to purchase that house outright.
So you want stability, someone that works, say, 40 years, someone has good income, steady income.
Of course. I'll address that in a little bit about employment as well too, okay, when it comes to securing a mortgage. Okay, so pre-approvals are essential, like Natalie Kachevarsnia has said, not only for the realtor's perspective, from a mortgage agent's perspective, and for reputability when you are approaching a lender as well too. Knowing your credit is crucial. Credit directly impacts the ability to secure lending. Have your payments been timely? Some of you may be wondering what ultimately impacts your credit score. So late payments on any of your loans or your credit cards will lower your score. Any collections or judgments or bankruptcies that are either made against you that have remained unpaid, or that you have filed for bankruptcy, that will negatively affect your credit score as well too. Any exceeded limits. Okay. Any exceeded limits on your credit cards or your lines of credit will negatively impact your credit score. As a rule of thumb, I would definitely say to keep your utilization below 50% if you're able to on any of your credit limits. And ideally, lenders and the insurer would like to see at least 2 years of solid credit history and 2 active trade lines at a minimum of a $2,000 limit. So those 2 active trade lines can either be car loans, credit cards, lines of credit, student loans as well too, OSAP loans. And for someone who is looking to start to establish their credit, I would recommend just going for, a credit card or a line of credit, with lower interest, and start to build your credit in that way. Use it when you know you have the funds available to pay it down right away, and that will help to continually build your credit for the positive. Employment is another huge factor that goes into pre-approvals and knowing that you're ready to purchase your first home. Stable employment and proof of employment for the past 2 years is beneficial. Mortgages as a whole does equal paperwork. So as a mortgage agent, I will be asking for a lot of paperwork, but this is because I want to make sure that you are ready and we have the proper information and it's verified before I tell you that you're able to go out and start shopping for a home with your realtor. And obviously it depends on what your employment situation, and that ultimately dictates what I will ask for. But as a rule of thumb, most mortgage agents and lenders will want to see 2 recent pay stubs, a letter of employment on company letterhead that's dated within 30 days of you applying for the mortgage. It needs to state your position, your length of time employed, your rate of pay, and any guaranteed hours, or if you're on a salary or contractual basis. They also like to see, or I like to see, 2 years of your T4s. So for this, past 2 years, it would be 2017, 2018, 2 years of your notice of assessments, and down payment verification. So where is your down payment coming from? Most lenders will ask for 30 days of a 90 days of a down payment history. They will want to make sure that those funds aren't borrowed and that they're your own and that they're accumulated savings. So that can be through financial statements, 3 months of bank statements, RRSP statements as well too. For a down payment, it can also be gifted. So gifted funds usually comes from, a close family member or a relative. People sometimes call it the bank of mom and dad. And with that, we would need a gift letter stating that those funds are non-repayable. So it's not a loan that they're giving you, it's a true gift in the form of a gift. When it comes to a down payment in Canada right now, minimum down payment is 5%, and that's on any purchase of $500,000 or less for a house. Above $500,000, you will have to put a 10% down payment down on any increment above $500,000. Anything less than a 20% down payment is classified as an insured mortgage, and that's where Rob will speak to you a little bit more in terms of that. The 3 main insurers in Canada are CMHC, Canada Guarantee, and Genworth. And Rob will talk to you about the importance of having that mortgage insurance and about mortgage premiums as a whole. And lastly, another topic that I wanted to touch on is closing costs. So closing costs are a cost that are payable by the first-time home buyer, but they are something that are not mortgaged or are not financed. Most lenders want to see at least 1.5% of closing costs, 1.5% of the purchase price of the house you're looking at in accumulated savings, okay? Closing costs usually entail lawyer fees, title insurance, an appraisal, and then as well to the land transfer tax or the land transfer fee. Ideally though, as a first-time home buyer, your closing costs will not be that much due to the fact that your land transfer tax or fee will be exempt if you're a first-time home buyer. For anything under 500,000, if it's an existing home, if you're looking at purchasing a new build, your land transfer tax or fee, you will be exempt for anything $750,000 or less. Okay. So Rob, I'm gonna let you take it over now, okay? And I'll pass the mic on to you. You're welcome, thank you.
Put it this way. Doesn't help if you put it underneath your coat, right? I'm just gonna make sure I can everybody see that okay? Yeah. Okay. So I want to first thank both Natalie's for inviting me to present for you today. I am a long professional in the financial services industry. I've been in it for 18 years. I've done pretty much everything. I was mentioning that I've been a financial planner since 2006. I've done branch management and a number of other roles throughout a number of different financial institutions over the years, some of which Natalie mentioned. I recently joined CMHC about 6 months ago. So I'm new to doing this part of CMHC, but I'm very familiar with CMHC and what they do. So I'm going to ask first, how many of us have heard of CMHC? And seen us on the news a lot lately? Yeah. I'm going to touch on that. I did bring some information regarding that because I'm sure somebody's going to have a question. But first, I'm going to talk a little bit about what we do. For you as a first-time home buyer, what we look for in terms of when you're applying and what we're looking for from a borrower perspective, property, and from the financing perspective, and that's for yourself. And I'm also going to give you a little tidbit on a program that we have that you may want to consider when you're buying your first home. How many people watch the Property Brothers or places like that where, they, as a financial planner, I cringe when I watch those shows. But there is some merit in what they do. And we do have a program at CMHC that actually can facilitate those things. So I'll get into that. Forgive me, because I do have my notes with me, because I have some stats in my memory. Been at it this long that my memory is not that great. So if I do refer to my notes, I'm going to give you a heads up. First off, who we are. So CMHC, we are actually, we have one shareholder. And who wants to take a guess at who our shareholder is? Bingo. That's bonus points. So yeah, we are a federal crown corporation. We're the only insurer that is profits go back to the government, which in turn come back to you as Canadians. We have been at it for about 70 years. We have a vast amount of data that we use to decision applications that you will be sending in as first-time home buyers. And not only that, we are the housing authority for Canada. Recently, we've launched a new strategy that by 2030, and this is a pretty lofty goal, everyone in Canada will have a home that meets their needs and is financially viable for them. So pretty lofty. We do have some chronic homelessness in Canada, so that the idea is that we eradicate that by 2030. So I'm going to talk to you about home buying, and I might refer. My son just did this 2 years ago when things were pretty crazy in the market, 2017, and he is, as a first-time home buyer, had many questions just like yourself. So I'm going to talk to you a little bit about. I'm going to interject what he went through as a first-time home buyer. The one thing that to consider when you're buying a home is the pros and cons. So the one thing I can tell you as a financial planner, I'll throw that hat on for a second. It's building equity. Your forced savings, you're putting money in your pocket. So that's the number one benefit or the number one pro that I see for my son and for anyone who's looking to get into the home purchasing. Some cons is that there's costs with home ownership. If your furnace goes, who's on the hook? We are. Exactly. So things to consider when you're looking for your first home. What are the potential costs that could come up? Talk to your real estate agent, talk to your mortgage advisor, and ask them, what are some unexpected unforeseen costs that may arise or I'm going to see as a first-time home buyer, and what to look for. Also, potential for rental income. Maybe you have a couple of bedrooms you rent to some friends or what have you. I know one of my friends in university bought a home and he put 6 bedrooms in it, renovated the basement, and he rented out and paid his mortgage with his buddies' money. It's a great idea. And today he's in his third home from there. Plus, you have the freedom to renovate. But the big thing is that the cons are usually associated with the cost of home ownership, the taxes, the insurance, homeowner insurance, and stuff like that. Is home ownership right for you? Ask yourself that question. Am I financially stable? Can I devote time to a regular home maintenance? So if I'm going to have a couple hundred square feet of lawn, do I want to cut the lawn every weekend or maybe during the week? Kind of thing. And am I ready to take responsibility for all the costs that come with being the homeowner? And do I have the financial management skills and discipline to handle a large purchase? It's the single largest debt in most cases for first-time home buyers, for any Canadian. As a matter of fact, when they buy a home, it's the largest investment you're going to make over time. It may be your first home, but you may buy other homes down the road. But as a first-time home buyer, it's usually the single most biggest investment that you'll make. So when you talk to your mortgage advisor or your real estate agent, you ask them about what are my mortgage options. We as CMHC get involved if there's less than 20% down on your mortgage. Okay? And we look at 3 basic things when we're deciding whether to approve the insurance. And we look at the borrower, we look at the property, and the financing options that are being chosen. Okay? And when financing means how does my income stack up against the costs of the home that I'm buying? Am I at my maximum? And I'll talk a little bit about what that means. Or do I have room for the unexpected kind of thing? From you as a borrower, I'm going to touch a little bit on your credit score and stability that was mentioned, and income and employment, stuff like that. First thing that I suggest when you're considering it, how many of us know how much our net worth is or how to calculate it? So I'll give you some homework. Early on, first-time home buyers, generally net worth is minimal, but there is usually positive net worth. Lenders will look for positive net worth in their applications. So positive net worth, calculating net worth means assets minus liabilities. What's an asset? You want to take a second? Vehicle, yeah.
Bank accounts.
Bank accounts, savings.
RSPs, RESPs for any of the children.
Yeah.
Any other properties, not for first-time home buyers, but then you may own any toys, right, that are not financed, books, equipment, jewelry, but, not other household items of not very much value.
So you take those things, you add up their values, and then you subtract what you owe. So that would be your OSAP loans, car loans, whatever you might owe, bank, mom and dad, and you establish a net worth. It's generally a good idea to have a positive net worth if you're going to get into home ownership and have some savings because of the unexpected, like a furnace goes or roof shingles go in a windstorm that we had recently, stuff like that. Review your monthly expenses. So if you're currently renting or if you're living at home with parents, what kind of expenses do you currently have? And then what are you going to end up with after your home purchase? And then get an idea of what your debt payments are. Some people, I'll be honest, have been doing this long enough that some people have no idea where their money goes in their bank account. It goes in and it goes right back out. And when I've asked them to sit down with me and do a budget, generally, 50% don't have an idea where their money goes. So. So how do we calculate if you can afford a mortgage? There's two calculations. There's this thing called gross debt service ratio, and the next one on the next slide is your total debt service ratio. It's a technical term for, can I afford a mortgage payment? What we look at for gross debt service is your gross income. So if you take if you're paid hourly, you multiply that by the number of hours you work over 52 weeks, or if you're paid a salary, you take those number and divide it by 12, it's your gross monthly income before taxes and all deductions, okay? Gross debt service takes your annual income, but it applies it against what the mortgage payment's gonna be, principal and interest, add in your taxes for the home, and your heating cost. And heating costs are calculated either, there's a minimum, but it's also based on square footage of the home to heat the home. Everybody needs heat in order to live, especially in the winter where we are, right? So we have to add that in. You take your mortgage payment, your taxes, your heat, and you divide it by your total gross income. And that gives your gross debt service ratio, as a technical mortgage advising term. Generally, rule of thumb, most lenders are 32% on this. They will go a little higher than that in some cases, depending on credit scores and stuff like that, which we'll talk about. And then the next thing they use to calculate if you can afford the home you're looking at is your total debt service. Okay, so they take that gross debt service ratio, so your monthly mortgage payment, your taxes, and your heat, and they tack on everything else. So all of your debt payments, line of credit, loan expenses, car payments, what have you, and divide it by your total gross income. This particular calculation can exceed, in most cases, most lenders, 40%. Can go a little higher than that, depending on your credit scores and stuff like that. I think we'll go, if my memory serves me correct, we'll go to 44. However, the thing I caution first-time homebuyers on in my career is that you don't want to be house poor. Okay, does anybody know what I mean by house poor?
You want to leave yourself in debt.
That's part of it. Yep. Yes, you're sitting in your house. You might not have TV. You might not be able to do anything other than live in your house, right? So when you're getting to 40 and 44% of your income for your housing cost, the rest of it goes to all of the other stuff you do, right? You're pushing the limit. I generally, most cases, when I sat with first-time home buyers, it was 35 was the sweet spot for me. 35% total debt service, because that left you 10% to save. Okay, so keep that as an idea. But sometimes it's not the case. Sometimes you max it out just to get in the home. Keep in mind that every mortgage payment you make is money in your own pocket, right? So that would be something to consider. So CMHC will look at, can you afford the home you're looking at? Then they're going to look at credit scores. Okay, we heard a little bit about credit scores already. Does anybody have an idea? Well, first off, I'm going to quiz you. Credit rating agencies, does anybody know who they are? There's two of them in Canada. No, that's actually a financial institution.
TransUnion.
Yep, that's one. Do you know the other one? Equifax.
Yes.
Credit Karma. It's one of those institutions. I can't remember which one it is, but Credit Karma is one of those. I see that commercial all the time. For what is it? The jingle that she sings. For us, credit score, we look at where your credit score lies, and when we use both agencies, we look at your history, so your repayment history on your credit. Usually we'll ask for 2 years. There is a newcomer to Canada program that we can get around some of that stuff. But we generally would like to see 2 years of credit history and what they call 2 trade lines. So a trade line would be a car loan. And then another trade line would be a credit card. And what we're looking for is regular repayment of those loan payments or your credit card minimum payment at least. And in order to qualify, we look at generally credit scores here and above. Yeah. Yep.
Say like you didn't have a good credit score, a cosigner, would that help in this area, or
Yes.
is that something different?
Yeah, we generally will, very rarely do we tell clients that they don't qualify. We will give an option to qualify. So it could be we need a strong co-signer, co-borrower, or guarantor, or something like that. Could be parents. I've seen that happen. So just depends on where you fall. We want to get people into homes. So if you have a good credit score and you've had the history there and your repayment, then you're usually pretty good. If you don't know your credit score, I urge you to go to Equifax, go to TransUnion. You can actually get it for free to find out what it is, or ask your mortgage advisor when they do the application. But we will generally look at credit scores of 600 or 650 and above to qualify for CMHC insurance. I'm going to talk about what the insurance actually is in a moment. I can skip that one. I talked about that. So talk a little bit about down payment. CMHC insurance or other insurers are required when you're putting less than 20% down on a property. It's required by the financial institution. The down payment is how much you have to put down. So if you get your purchase price, you put down so much money, and it needs to be 5% of that purchase price. Okay. So I'm going to ask a quick question. What are some sources of down payment? What would you use to put down on a house? Savings, yeah. What are some other things? A gift, yeah. There's two kinds of gifts. I'm going to talk about those in a second. Inheritance, yeah. RSPs, yeah. We've heard a lot about that in the news recently. Anything else? I'm flipping to the right page here, sorry. Just catching up with myself. Yeah, equity, yeah. Can you borrow? Don't see why not. Perfect. Yes, you can actually borrow your down payment. Do I suggest it? But yes, borrowed funds against proven assets. So an example I use would be a tax-free savings account, because you can actually borrow against tax-free savings accounts as long as it's in cash or whatever. You can borrow against it and use that as a down payment as opposed to liquidating your tax-free. So there's certain things that you can do. Those are all considered traditional sources of down payment. Non-traditional, we heard the word gift. So non-traditional down payment. So, you can get gifts from family members, bank of mom and dad, grandparents, inheritance, what have you, they can be gifts, right? Those are considered traditional. A non-traditional would be a gift from somebody within arm's length of that purchase. Okay. So meaning somebody that's involved in the purchase of the property. Borrowed funds are also considered as a non-traditional down payment if they're not secured against a financial asset. Okay. So yes, you can borrow. Depends on the lender though. Not all lenders will accept a borrowed down payment. That's something to ask Natalie about. Okay. Keep in mind too that if it's a borrowed down payment, the payment, if we go back to that total debt service calculation, that gross debt service calculation, that payment gets rolled into that calculation, meaning you'll have less house for your purchase. Okay. So what is mortgage loan insurance? But you're all wondering, why is CMHC? What is mortgage loan insurance? It's insurance. How many of us do we have life insurance or any kind of insurance, car insurance, renter's insurance if you're renting, right? So CMHC or mortgage loan insurance is required by the lender if a buyer is putting less than 20% down. And what happens is that protects the lender in the event of default from a home buyer, okay, down the road. What happens is that lender passes on the cost of that insurance or the premium onto the buyer, onto the mortgager. And there's ways that I'll talk about in a second what happens to that premium. But the premium is actually, you're paying the premium, but the insurance is actually for the lender. Okay. And it helps the lender in a case that, you know, the first time home buyer, for whatever reason, something happens and they can't pay the mortgage. So there's a misconception that's insurance and it's a benefit to me as the buyer. Well, technically, it does, the benefit to you as a buyer is it allows you to get into home earlier because you can save less, but it also will give you the opportunity to get interest rates that are equivalent to those that would put 20% or more down on their home, right? Otherwise, because the risk associated with less down, you might, without the insurance, Canadians would have the opportunity wouldn't have the opportunity for those rates without the insurance. Okay. Any questions so far? So here's an example of why it's important, or how we can help, how CMHC mortgage loan insurance can help. So this is an actual listing. I apologize, again, my memory. I think it was Erin Drive, which is north, a little bit north St. Catharines. This is an actual listing, $439,900. What I did was I tried to pull a listing that coincides with the average price right now, which I'll show you some interesting statistics. What it does is it allows you to get into this home with as little as $21,000 down. If without the insurance, you would need almost $90,000. And as a first-time home buyer, your first home, show of hands, do you have $90,000 in the bank? Well, my son didn't. So it does give you the opportunity to get into a home much sooner. And here's what it costs. So you can put anything up to, as long as it's 5% down. So you can put any amount over and above that. The more you put down, obviously, the better. It saves you interest over the long term. But if you put 90 to 95% down, whether it be traditional or non-traditional, your insurance premium is going to be 4.5%. And then it reduces the more you put down, 3.1 for 85 to 90 and 2.8 for 80 to 85. And then in some cases, if you do more than 80%, I have seen insurance used, but not always.
So that's $21,000 down payment of the other $440,000.
Yep.
Is that 5%?
That's 5% down. That's the minimum amount you would need to put down. Yeah. Okay. So here's an example. So this house has a purchase price of $450,000. At 80% financing, we're putting $90,000 down. Your mortgage is going to be $360,000. Okay. If you were to do the high ratio mortgage and put 5% down, same purchase price, your $427,500 is now your mortgage. Down payment of $22,500, and your mortgage loan insurance is $17,100. If we subtract the down payment from the conventional or the 20% down mortgage, there's a $50,000 difference that you don't have to come up with. Okay. What does it mean for your mortgage payment though? So I'm putting less down. What do you think it does to the mortgage payment? Exactly, right? So there is a cause and effect that the more you put down, the lower your mortgage payment's going to be. Here's an example of the actual payment, what it does to the payment. So on the 80% downside, you can see the mortgage payment on the bottom would be $2,164 a month. Okay. On this side, if you use the mortgage insurance and do 5% down, mortgage loan insurance, you can see the effect on the payment, about $500 higher. So there is an effect by putting less down. But if you had $50,000 in the bank, you still have $50,000 in your pocket, right? But you could do other things with. The mortgage on the 95% financing side would be $444,600, because what happens is that mortgage insurance premium gets added to the mortgage balance. Okay, so you put $22,500 down, but the lender will add the 17,100 in insurance premium to the mortgage, so your mortgage is actually a little bit higher than that. Okay. How many of us have heard of the stress test? It's our favorite word, stress. The stress test came in 2018, early 2018, 2017. And it was to Canada Emergent Housing Corporation is, its goal is to stabilize the housing market. Housing prices were going crazy. I know I was working at a financial institution in Niagara at the time, and the housing prices were going up $20,000, $30,000 in 6 months. So what happened is the federal government decides, well, we're gonna slow things down. We gotta calm the housing market down to make it stable, and they introduced the stress test. So they first introduced it on the less than 20% down. Then they added it to the 80% down. And what it is, when you apply for your mortgage, interest rates are roughly 3.5% right now, 5-year. Normally, you would, before the stress testing, you would apply for your mortgage and be qualified at an interest rate of 3.5%. Well, with the stress test, it's now the qualifying interest or the greater of the mortgage contract interest rate or the Bank of Canada's 5-year fixed posted rate. Okay? Which means if you Google Bank of Canada posted rate, that's the interest rate that they're going to qualify you at. Okay, it'll come up, Bank of Canada, show you the rate. It generally is a couple of percent higher than that, than 3.5%. I think it's 5.4 or something right now. 3.4, yeah, that's it. If on the side where you're putting 20% down, they still, the stress test has now come into effect where you'll qualify at the contract rate plus 2%. Okay? The idea behind it is that if you are maxing out, that you can handle an increase in interest rates. So most choose a 5-year mortgage, in my experience, some 2, some 1 year. Mortgage terms can range anywhere from 1 up to 10 years. Generally, most choose a 5-year. So what would happen if you were qualified at 3.5, 5 years down the road, the interest rate is doubled. Now you're paying 6.5%. You're going to pay a lot more in your mortgage payment, right? So the stress test is to get you to a place that you can handle that, because they're predicting, the federal government, to me, they're predicting that the interest rates are going to rise over time. So here's a quick example of qualifying at the contract rate versus the Bank of Canada's 5-year fixed posted rate. So on this side, your mortgage payment would be, your actual mortgage payment at 3.5% would be $1,497 on a $300,000 mortgage. But to qualify for this mortgage, they're going to qualify you at 5.34% and a mortgage payment of $1,803. So there's almost a $400 or $300 buffer there in an increase in mortgage payment if interest rates were to rise over that time period of your term or your mortgage. Any questions on that? Any questions about CMHC before I move on to the next couple slides? So I thought I would share a couple of interesting statistics with you, and I'm going to flip to the right page again, catch up with myself. This information, I didn't pull it out of the air. It's from CREA, it's called, Niagara Association of Realtors, I believe so. Canadian Real Estate Association, yes. And what it is some recent statistics in Niagara, in St. Catharines, Niagara region. This middle graph here is the average price of a home since 2010 to middle of last year, July. It's showing July 2018. Didn't quite get all of the, but you can see the general price increase of houses over time. That's one benefit to owning a home. Okay, if you are looking for a home. These two over here are job growth. So this particular one is the unemployment rate, And this particular one is job growth. That says Hamilton, but the graph actually is the same for St. Catharines, Niagara. So unemployment is falling or been stable for the last little while. Job growth has been good the last few months. So some interesting statistics. Benchmark price for a single family home, $400,000, up 6.1%, $400,100, up 6.1% on a year-over-year basis in February. So if you bought a home February last year to February this year, you had a 6.1% increase in the value of your home. Okay? By comparison, a townhouse or a row unit was $324,500, up 7.7% from this time last year. The apartment price was $282,700, rising 15.7%. So across the board, regardless of the home you're looking at, prices are still increasing. Okay. The average price of homes sold in February alone was 424, and year-to-date average price 403. So from January till now, $857. Unemployment was 6.9% at the end of February, unchanged from the previous month. There were 2,500 more jobs in February from the month earlier, full-time jobs, but a loss of 1,700 jobs on the part-time side, for an increase of 800 jobs in February. The reason I'm mentioning this is, how many of us have heard of the GO train coming, right? The Toronto effect, anybody heard that? So people in Toronto migrating, so they're buying where they can afford. What's happening, if you're driving down the QEW, it doesn't matter what day, what time, there's always a slowdown between here and, now it's between here and Hamilton. It used to be between Hamilton and Oakville, but it's now progressing this way. So what's happening is when you're seeing employment and you're seeing a low unemployment rate, that means there's jobs here. That's going to attract people to our region, right? Which is going to push home prices up because supply's down, I think. So you can see, just to give you an idea of what's happening in Hamilton, Niagara area, or the St. Catharines, Niagara area. Anybody see that information? This is information from last quarter. So I point down here. So Q4 of 2018 from Q4 of 2017. Q4 means the last 3 months. In St. Catharines, the median sale price was $410,000, up from $375,000 a quarter earlier to 9.3% of an increase from the year earlier. Last quarter in Niagara Falls, Fort Erie, the average price or median sale price was $362,000, up from $344,000 the year previous, an increase of 5.1. And in Welland, we're seeing $344 for last quarter versus $335,000, an increase of almost 3%. So anywhere in Niagara, you're seeing the same trend where prices are going up. Sales, however, the number of sales have come down a bit. So for instance, Welland in Q4 of 2018 had 231 unit sales, down from 281 in the previous quarter, the same quarter the previous year, which is a drop of about 18%. So you can see what's happening in the area. Any questions on any of that? No? So I'm going to talk about the Property Brothers episodes. Okay. One of the programs that CMHC offers, and it's a very underutilized program. It's called our Purchase Plus Improvement Program. So as first-time home buyers, depending on your affordability, what you're looking at for a home, you may want to, or you may need to do a renovation of some sort. Okay. When you get in, how do you come up with the money for that? Right. Well, this program will help with that. So here's that same listing. Okay. If you can see that, it's the same listing. This is a picture of the kitchen. Some might like that, some might not. How many of us like that kitchen? No. Okay. It's very cookie cutter. Open concept is the thing to have these days. Maybe you want to renovate the kitchen. That's the first thing you want to do when you get in the house. But what if I told you there's a way to do that? Would you be happy about that? And there's a way you can do it that you don't have to come up with $50,000 right up front out of your pocket. So the Purchase Plus Improvement Program allows you to do the renovation, borrow a little more money, but attach that renovation cost to your mortgage and build it into your mortgage payment. Okay. So if I'm going to do a $10,000 or $20,000 or $50,000 renovation, I can actually do it the moment I move in, and I can add it to my mortgage payment. I don't have to come up with the extra money. Okay. What a great option, right? This is an example of doing it now versus later. So say for instance, if I do a 95%, I do my 5% down, I want to do a $20,000 renovation. I can base it on the fact that $20,000 of additional value in my property, and I can do the renovation today, or I can wait until I have enough that I can add it to my mortgage later on. Well, in order to do that in today's world, you have to get down to a conventional space in terms of your mortgage, and refinancing from what I hear is a little harder these days. So you have to wait until you're below 80%, and you have some equity in your home. That could take a long time, right? Or if you're going to do an 80% or put 20% down, then you're using all the money that you might have put down for a renovation kind of thing. So this allows you to do it right now and only still put 5% down on your home. Okay. And how do we do that? So we look at an as improved value. So that particular home, if I wanted to go in and renovate the kitchen, knock out a wall, make it big, put in the granite countertops, beautiful appliances, we base it on either the purchase price, recent sales. Now this is dependent also on the lender and what their policies and procedures are with respect to this program. List of improvements, cost estimates and quotes, or a third-party report from a qualified professional, which is usually an appraisal. Okay. List of improvements. So one thing that we look for in this particular program is a quote. So if I want to do the renovation on that kitchen, all we need is a quote of how much it would cost to do that renovation. Okay. And then the lender would add it to your mortgage based on what the as improved value would be. I did one in my lending days where it was $100,000 and an addition to a house. So we've actually put on a second floor. That in that case is a little more complicated, but it is doable. So there's two types. There's a small scale renovation, a large scale. You can, if you're less than 10% of the as improved value, it can be done as a single advance. Your lender may want to have, your lender will, we need proof that the renovation is complete, but they can, there's no extra work. It's, here's 50,000. So if you based it on a house that's $400,000, 10% of just the purchase price alone, that's 40,000, right? The as improved could be 490, 10% of 490 would be 49,000, right? It's a lot of money based on the average price. And then if it's greater than 10% of the as improved value, it's done as they call a construction draw. So we'll advance the money at stages of completion. And I can let mortgage advisor talk about what those things would be based on the lender and how they handle it. Each lender is different. But the idea is that if you are interested in doing what the Property Brothers do when you buy your house, that's an option. And it could be a viable, low-cost option and not have that much impact on your costs or your expenses.
That's only an option for first time?
That's an option anytime. Yep. Yep. So it could be second, third home. Yep. If you're only going to put 5 or 10 or 15% down. One thing to add to that, I handed out a little flyer there for you. It says "Go Green, Get Green." So if you're buying your first home, and it happens to be an energy efficient home, or if you're going to renovate and make it energy efficient, there may be opportunity to get some money back in your pocket. I'm not going to go into much detail on it. I urge you to visit our website, cmhc.ca. Check out the Green Home program. It's actually cmhc.ca/greenhome. And you can actually get a refund of up to 25% of your premium if you buy a energy efficient home or you do some energy efficient upgrades. There's a lot of stipulations of what qualifies as energy efficient. And the reason why I won't go into it today, because it's a whole other presentation, but take some time to check that out if you do buy an energy efficient home, because 25% of $17,000 is a fairly big chunk of change. A feel good story. A mortgage advisor called up a recent purchaser. They bought a energy efficient home, called them up and said, "Are you aware of the CMHC Green Home program?" And they said, "Actually, no, I'm not." Well, check it out. Go to the website. It's really easy to apply. The application is online and it goes to CMHC. They did that, and the mortgage advisor got a call about sometime later, a couple months or what have you, however long it takes. They got a check in the mail, and he called in tears telling the mortgage advisor, "Thank you for the advice, because and I can go on my honeymoon now with my wife." They were newly married, new home, forfeited the honeymoon to buy the house. Got a check for over $5,000 in the mail, and they were going on their honeymoon, and because they were aware of the program. So a feel good story. Yep.
Timeline to apply for something like that?
I want to say, I don't want to speak out of turn. I think it's 2 years. Yes. Again, it's a number, and my memory is really poor. So something really to consider if you're looking for your first home. Is it an energy efficient home? There might be some money that comes back to you. Next thing I want to suggest, check out our website, not only for the Green Home program, but we have a number of calculators that you can use if you're, how much can I afford, calculating stuff like that. There's a mortgage calculator, affordability calculator, debt service. The one I showed, like the calculation, you can punch in some numbers. It'll give you what you're looking at. I'm sure Natalie. Yeah.
I have my own
You have your own app and calculators. Yeah. So I'm sure between that and others that there's lots of tools to calculate what you can afford. I've given everybody the step-by-step guides. There's a guide and a workbook. These are very popular. People love them because it has some useful tips and some guides to guide you through the home purchasing process. My biggest piece of advice: get a team of professionals behind you. There's 2 of them right here. Find yourself a good lawyer, one that's cheap, but still good, and just enjoy the process, because it's a really exciting. My son, when he bought his first home, the pride and ownership that he had when he got into his house for the first time was just fabulous. It was fantastic, and from a personal experience, to see his face glow when he had something he could call his own, versus renting was amazing. And that's the end of my presentation. Any questions? Thank you. Before I go, because I know everybody heard about CMHC on the news, so I thought I would touch on this. There's more details to come. However, the budget for this that just came out from the federal government, 2 things in there that will help first-time home buyers. Okay. There's one that's called the Home Buyers Incentive. I don't have a lot of detail. We haven't been given the information. However, to make, and I'm just going to read it verbatim, to make home ownership more affordable for first-time home buyers, there's going to be an incentive for eligible first-time buyers who have a minimum down payment for an insured mortgage. Those who qualify, a first-time home buyer, 10% shared equity mortgage for a newly constructed home. So what essentially it is you're putting your 5% down. An additional 10 is coming from CMHC, which is essentially going to lower your mortgage. Okay. I don't know any more details from that beyond that. Or if you're 5% down on an existing home, then the incentive will be 5% from CMHC. Okay, so who doesn't like free money? The incentive would be available to those first-time home buyers with household incomes under 120,000 a year. So there's an income threshold, and the incentive amount cannot be greater than 4 times the participant's annual household incomes. So the amount that is advanced can't be more than 4 times your income. Okay. The other thing, if you do have RSPs, some great news. First-time home buyer plan. They've upped the limit, the withdrawal limit to 35,000, and that's per person. So if there's 2 people buying a home, you're both buying together, each person has the ability to pull out $35,000 from their RSPs. Right, so keep that in mind when you're searching. If you don't know what the first-time home buyers plan is, seek it out, find out, because it's a really great, useful tool for first-time home buyers. So I won't go into it because it's another presentation. But thank you very much, and hopefully if you have questions, I can stick around. You're welcome.
Okay, so thank you everyone for coming tonight. Again, if you have any questions for any of the realtors here, or Rob or Natalie Torner, please, hang around and ask any questions. We also have some nice refreshments and snacks in the back. And yeah, we're all here to help out. So thanks so much.